One of the key things, and we're going to segue again here for the folks on the call, that we look at is we often have people in the management operation here as we manage properties across the United States where they have bought a single property and they're ready to buy another property. How can you directly assist an investor looking to build their portfolio?
Sure. So what we do is kind of a cash flow analysis. We look at depending on how extensive the portfolio is, we would want to look at the, schedule of real estate, which is basically just all the basic information. What's the property? What type of property is it? What's it worth approximately? How much debt do you have on it? And usually for us, it jumps right off the page as to which property you might want to pull some equity out on. It's
Mhm.
usually the ones that either have an existing high rate or ones that have a lot of equity. If they have a lot of equity and they have a low rate on an existing mortgage, that's when second liens come in place, and could be a better way so that you don't have to replace your nice low mortgage. Because a lot of times, what we find, Dale, is that people who own an investment property, that property used to be their primary residence. So maybe back in 2021, when rates were at 3% or less, they got that mortgage, and nobody wants to get rid of that, nor should you, unless there's some extenuating circumstances. So second mortgages, which would come in the form of either a HELOC or a what we call a fixed rate second mortgage, which is where you get an actual lump sum. It's not an equity line to draw on, but more of a full lump sum that you get the entire amount at closing, could be a better solution in that case. But what we typically do is, kind of a cash flow and portfolio analysis to try to figure out, if you own multiple properties, where would be the most appropriate place to pull the equity from so that you can use that money, for the down payment or renovations or whatever it may be for the new property that you want to buy. So using one property to acquire another is like playing with the house's money. And that's, leverage is an important thing for investors, because if you had to just wait until you save enough money for a down payment on another property, you're not going to buy for years down the road, longer than it would be if you leverage from another property that you already own. So you can speed up the process of building your portfolio, and real estate is a long game. So the earlier you get in, the more you benefit. Nobody who bought 20 years ago is questioning their judgment, because those properties are worth so much more now than they were at that time. So pulling equity from another property is a great solution. Some people refer to it as the Burr model, which includes buying, renovating, refinancing, and then taking out money and then buying another property with those funds, or just pocketing the money. That's another way to do it too. Non-taxable event by borrowing money. So there's a lot of creative ways to pull equity out of one property to buy another.